Question 1. Which of the following is a primary benefit of forming a captive insurance company in North Dakota? A. Reduced operational costs due to tax exemptions on insurance premiums. B. Greater control over risk management and underwriting decisions. C. The ability to offer insurance coverage only for in-state risks. D. Access to unlimited reinsurance options from global insurers. Answer: B. Greater control over risk management and underwriting decisions. Explanation: one of the main reasons companies form a captive insurance company is to gain greater control over their risk management and underwriting decisions. In North Dakota, this advantage is enhanced by the state's regulatory environment, which allows captive owners to tailor insurance policies specifically to their business needs. Unlike traditional insurance, where the insurer controls underwriting, captives allow businesses to directly influence the coverage terms, premium amounts, and claims handling processes. Why the other options are incorrect. Option A. North Dakota does not exempt captive insurers from paying taxes on insurance premiums, though they may have tax advantages related to formation and operation. Option C. Captives are not restricted to offering insurance only for in-state risks, and they can cover a broad range of risks, including global exposures. Option D. Captive insurance companies may engage in reinsurance, but they are not granted unlimited access to reinsurance options without meeting certain regulatory and financial requirements. Question 2. A business considering the formation of a captive insurance company in North Dakota must ensure they meet certain minimum capital requirements. Which of the following statements is true regarding the capital and surplus requirements for captives in North Dakota? A. North Dakota captives are required to maintain a minimum of $500,000 in capital and surplus. B. The capital and surplus requirements are based on the risk exposure and underwriting activities of the captive. C. North Dakota captives must maintain $1 million in capital for the first year of operation, with no requirement after that. D. Captives in North Dakota are not required to have any minimum capital or surplus. Answer: B. The capital and surplus requirements are based on the risk exposure and underwriting activities of the captive. Explanation: in North Dakota, the minimum capital and surplus requirements for captive insurance companies are not fixed, but are instead determined based on the nature of the risks being underwritten and the overall exposure of the captive. The North Dakota Insurance Department evaluates the captive's business plan and financial projections to establish appropriate capital and surplus levels. This ensures that the captive has sufficient financial resources to cover its anticipated liabilities. Why the other options are incorrect. Option A. There is no fixed capital requirement of $500,000 for all captives. Requirements are tailored based on risk exposure. Option C. There is no requirement for captives to maintain $1 million in capital specifically for the first year. Capital requirements depend on business risks. Option D. Captives in North Dakota must meet certain minimum capital and surplus requirements, so they are not exempt from these rules. Question 3. Scenario question. Mr. Davis owns a medium-sized manufacturing company and is considering establishing a captive insurance company to handle his business's liability risks. He is evaluating the process of forming a captive in North Dakota. What should Mr. Davis do first in order to comply with North Dakota regulations for captive insurance formation? A. Secure a reinsurance agreement with a global insurance provider to back his captive's coverage. B. Submit an application to the North Dakota Insurance Department and provide a comprehensive business plan detailing the risks and premiums. C. Start offering liability insurance immediately and wait for the state's approval. D. Establish an insurance management team and begin issuing policies directly to customers. Answer: B. Submit an application to the North Dakota Insurance Department and provide a comprehensive business plan detailing the risks and premiums. Explanation: to establish a captive insurance company in North Dakota, Mr. Davis must first submit an application to the North Dakota Insurance Department. This application includes a detailed business plan that outlines the proposed risks to be covered, the types of insurance products to be written, and the premiums to be charged. The Insurance Department evaluates the business plan to ensure that the captive meets all regulatory requirements, including minimum capital and surplus levels. Why the other options are incorrect. Option A. Securing a reinsurance agreement is not the first step in forming a captive. It comes later in the process once the captive is operational. Option C. Mr. Davis cannot begin offering insurance before receiving approval from the North Dakota Insurance Department. A thorough application process is required. Option D. Establishing an insurance management team and issuing policies is premature before the captive has received regulatory approval. Question 4. Which of the following correctly describes the tax treatment of captive insurance companies in North Dakota? A. Captive insurance companies are exempt from all state taxes on premiums received. B. Premium taxes are applied at a reduced rate compared to traditional insurers with limits on annual tax liability. C. North Dakota captives pay the same federal and state taxes as traditional insurance companies. D. Captive insurance companies must pay a flat tax rate regardless of premium volume or operations. Answer: B. Premium taxes are applied at a reduced rate compared to traditional insurers, with limits on annual tax liability. Explanation: North Dakota provides tax advantages to captives, including a reduced premium tax rate compared to traditional insurers and a cap on annual premium tax liability. These benefits make forming a captive in North Dakota attractive for companies seeking cost efficiency while managing their risks. Federal taxes may still apply, but the state offers these incentives to encourage captive formation. While the other options are incorrect. Option A: captives are not fully exempt from state taxes, and they benefit from reduced rates and caps. Option C: federal tax requirements may apply, but state taxes are structured differently for captives. Option D: tax rates are not flat, they are based on premium volume and are subject to caps. Question 5. Which of the following is not typically a function of a captive insurance company? A. Providing insurance coverage for unique or specialized risks not covered by the traditional market. B. Serving as a direct insurer for unrelated third-party businesses outside the parent organization. C. Acting as a risk financing mechanism for the parent company and its subsidiaries. D. Offering reinsurance to transfer certain risks to third-party reinsurers. Answer: B. Serving as a direct insurer for unrelated third-party businesses outside the parent organization. Explanation: a captive insurance company is primarily established to provide insurance for its parent company and affiliates, not for unrelated third-party businesses. Allowing captives to insure unrelated third parties would contradict their regulatory purpose and might require the captive to operate as a traditional insurer, which involves different licensing and compliance standards. Why the other options are incorrect. Option A: captives often address specialized risks that the traditional market cannot cover. Option C: risk financing for the parent company and affiliates is a core purpose of captives. Option D: captives frequently use reinsurance to manage and diversify their risk exposures. Question 6. Scenario question. Ms. Patel runs a healthcare company and has formed a captive insurance company in North Dakota. During a financial audit, she discovers her captive is under-reserved for potential malpractice claims. What steps should Ms. Patel take to comply with North Dakota regulations and protect her captive's solvency? A. Increase her captive's surplus funds immediately and report the issue to the North Dakota Insurance Department. B. Delay addressing the issue until the next financial reporting cycle to avoid immediate penalties. C. Cease writing new insurance policies until all outstanding claims are resolved. D. Purchase additional reinsurance coverage to offset the under-reserved liability. Answer A. Increase her captive surplus funds immediately and report the issue to the North Dakota Insurance Department. Explanation: North Dakota regulations require captives to maintain sufficient reserves to cover their liabilities. If Ms. Patel identifies under-reserving, she must take corrective action by increasing her captive surplus funds to ensure solvency. Additionally, she must inform the North Dakota Insurance Department, as transparency is a critical regulatory requirement. Why the other options are incorrect. Option B: delaying action violates compliance requirements and could result in penalties. Option C: ceasing policy issuance does not address the root issue of insufficient reserves. Option D: reinsurance can help manage risk but does not directly resolve under-reserving. Question 7. In North Dakota, what is a protected cell captive (PCC) and how does it differ from a traditional single-parent captive? A PCC allows multiple businesses to share one insurance license but does not provide legal separation of risks. B. A PCC is structured to legally segregate the assets and liabilities of different cells within a single captive. C. A PCC operates solely as a reinsurer for other captives and cannot write primary insurance. D. A PCC requires each cell to meet independent minimum capital requirements as if it were a standalone captive. Answer: B. A PCC is structured to legally segregate the assets and liabilities of different cells within a single captive. Explanation: A protected cell captive (PCC) in North Dakota is designed to allow separate cells within a single captive insurance entity. Each cell's assets and liabilities are legally segregated, ensuring that risks from one cell do not affect the others. This structure provides flexibility and cost efficiency for companies that want to participate in captive insurance without forming independent captives. Why the other options are incorrect. Option A: risks and assets are legally separated within a PCC. Option C: PCCS can write both primary and reinsurance policies. Option D: while cells operate independently, the overall capital requirement is typically assessed for the PCC as a whole. Question 8. Which of the following best describes the role of reinsurance in captive insurance? A. Reinsurance eliminates all risk for the captive by transferring it to a third party. B. Reinsurance is used to reduce the captive's overall risk exposure while maintaining its primary coverage responsibilities. C. Reinsurance is required by law for all captives operating in North Dakota. D. Reinsurance allows captives to avoid filing annual financial reports with the state. Answer: B. Reinsurance is used to reduce the captive's overall risk exposure while maintaining its primary coverage responsibilities. Explanation: reinsurance allows captives to transfer a portion of their risk to third-party reinsurers, enabling them to manage large or catastrophic exposures while still retaining control over primary risk coverage. This strategy helps captives maintain financial stability and comply with solvency requirements. Why the other options are incorrect. Option A: reinsurance reduces but does not eliminate all risks for the captive. Option C: reinsurance is not mandatory for all captives. Its use depends on the captive's risk profile. Option D: captives are still required to file financial reports regardless of reinsurance agreements. Question 9. Which of the following factors is most important when determining premium rates for a captive insurance company? A. Competitor pricing in the traditional insurance market. B. The anticipated claims frequency and severity based on actuarial data. C. The parent company's total revenue and profit margins. D. The availability of third-party reinsurance coverage. Answer: B. The anticipated claims frequency and severity based on actuarial data. Explanation: premium rates for captives are primarily determined by actuarial analysis of the expected frequency and severity of claims. This ensures the premiums are adequate to cover anticipated losses, administrative costs, and regulatory reserve requirements. Captives do not base their pricing on external competition, but rather on their specific risk profiles. Why the other options are incorrect. Option A: captives do not typically compete with traditional insurers on price. Option C: revenue and profit margins of the parent company do not directly influence premium rates. Option D: while reinsurance impacts overall risk management, it is not the primary determinant of premium rates. Question 10. What is the purpose of Solvency II principles in the context of captive insurance in North Dakota? A. To provide captives with a legal framework for international tax exemptions. B. To align captive solvency requirements with global risk management standards. C. To establish a fixed premium tax rate for captives operating internationally. D. To exempt North Dakota captives from U.S. federal regulatory oversight. Answer: B. To align captive solvency requirements with global risk management standards. Explanation: Solvency II principles, though originating in the European Union, influence North Dakota captives by providing a framework for managing solvency, risk-based capital, and governance to ensure financial stability. Adopting such standards enables captives to operate competitively in global markets while maintaining high levels of risk management. Why the other options are incorrect. Option A: Solvency II is not about granting tax exemptions. Option C: it does not establish tax rates. Option D: Solvency II principles complement rather than exempt federal oversight requirements. Question 11. What is the primary advantage of establishing a captive insurance company in North Dakota compared to other states? A. Exemption from all federal taxes. B. Flexible regulatory framework tailored to diverse captive structures. C. A guaranteed reduction in premium tax rates for all captives. D. No minimum capital requirements for captives. Answer: B. Flexible regulatory framework tailored to diverse captive structures. Explanation: North Dakota offers a flexible regulatory framework that accommodates various captive structures, such as single-parent captives, group captives, and protected cell captives. This adaptability encourages businesses with unique risk profiles to domicile their captives in the state. Why the other options are incorrect. Option A: federal taxes are not exempt for captives. Option C: Premium tax reductions may apply but are not guaranteed for all captives. Option D. Captives must meet minimum capital requirements as stipulated by state law. Question 12. Which type of risk is most commonly self-insured through a captive insurance company? A. Speculative risks, such as investment opportunities. B. Catastrophic risks, such as earthquakes or major floods. C. Predictable operational risks, such as employee benefits and liability. D. Non-insurable risks, such as reputational damage. Answer: C. Predictable operational risks, such as employee benefits and liability. Explanation: captives are commonly used to self-insure predictable risks that are expensive or difficult to insure in the traditional market. Examples include workers' compensation, general liability, and employee benefits. Why the other options are incorrect. Option A. Speculative risks are not typically insured. Option B. While captives can help manage catastrophic risks, they are more commonly used for predictable risks. Option D. Reputational damage is generally non-insurable. Question 13. What distinguishes a group captive from a single-parent captive in North Dakota? A. Group captives are owned and operated by a single-parent company. B. Group captives require federal approval, unlike single-parent captives. C. Group captives are owned by multiple unrelated entities with shared risks. D. Group captives cannot provide reinsurance coverage. Answer: C. Group captives are owned by multiple unrelated entities with shared risks. Explanation: a group captive is jointly owned by multiple entities that pool their resources to ensure shared risks. This structure allows businesses to gain cost efficiencies and manage risks collaboratively, while the other options are incorrect. Option A. Single-parent captives are owned by one company. Option B. Federal approval is not specific to group captives. Option D. Group captives can provide reinsurance coverage. Question 14. Which of the following is a key benefit of the protected cell structure in North Dakota? A. Full tax exemption for all participating cells. B. Legal segregation of assets and liabilities between cells. C. Elimination of state regulatory oversight for each cell. D. Reduced reporting requirements for parent companies. Answer: B. Legal segregation of assets and liabilities between cells. Explanation: protected cell captives ensure that each cell's assets and liabilities are legally segregated, protecting one cell from the financial risks of others. This separation enhances security for participants, while the other options are incorrect. Option A. Tax exemptions are not guaranteed. Option C. Regulatory oversight applies to the entire structure. Option D. Reporting requirements are not reduced but may be streamlined. Question 15. In North Dakota, what is the minimum capital requirement for forming a single-parent captive? A. $100,000. B. $250,000. C. $500,000. D. $1 million. Answer: B. $250,000. Explanation: North Dakota requires single-parent captives to maintain a minimum capital level of $250,000 to ensure solvency and the ability to cover liabilities. Why the other options are incorrect. Option A. This amount is below the regulatory threshold. Options C and D. These amounts exceed the requirement for single-parent captives. Question 16. Scenario question: a North Dakota-based captive has exceeded its annual premium tax cap but continues to generate additional premiums. How should the captive handle its tax obligations for the remainder of the year? A. Stop collecting premiums to avoid further tax liabilities. B. Pay additional taxes at the cap rate. C. Report premiums without paying additional taxes as the cap has been reached. D. Apply for an exemption from further reporting requirements. Answer: C. Report premiums without paying additional taxes as the cap has been reached. Explanation: North Dakota imposes a cap on annual premium taxes for captives. Once the cap is reached, no further taxes are due for the year, but premiums must still be reported to ensure regulatory compliance. Why the other options are incorrect. Option A. Captives cannot cease operations arbitrarily. Option B. Taxes are not payable beyond the cap. Option D. Exemptions from reporting are not allowed. Question 17. Which of the following best describes the role of fronting in captive insurance? A. A captive insurance company fronts as a third-party reinsurer for unrelated businesses. B. Fronting involves using a licensed insurer to issue policies and reinsure the risk to the captive. C. Fronting is a method to reduce premium taxes for captives. D. Fronting eliminates the need for state regulatory compliance. Answer: B. Fronting involves using a licensed insurer to issue policies and reinsure the risk to the captive. Explanation: Fronting is a common practice where a licensed insurer issues policies on behalf of a captive and then reinsures the risk back to the captive. This allows captives to meet licensing and regulatory requirements while retaining risk, while the other options are incorrect. Option A, captives do not act as fronting insurers for unrelated businesses. Option C, fronting is unrelated to premium tax strategies. Option D, regulatory compliance is still required. Question 18. What is the purpose of a feasibility study when forming a captive in North Dakota? A. To bypass state regulatory requirements. B. To evaluate the parent company's ability to profit from the captive. C. To assess whether the captive structure aligns with the company's risk management needs. D. To establish federal tax exemptions for the captive. Answer: C. To assess whether the captive structure aligns with the company's risk management needs. Explanation: a feasibility study evaluates the parent company's risks, financial capabilities, and objectives to determine whether forming a captive is a viable and beneficial option. It helps identify appropriate structures and potential challenges. Why the other options are incorrect. Option A, feasibility studies do not bypass regulations. Option B, the focus is on risk management, not profit. Option D, tax considerations are not the sole purpose. Question 19. In North Dakota, what is the maximum annual premium tax cap for captive insurance companies? A. $50,000. B. $75,000. C. $100,000. D. $150,000. Answer: B. $75,000. Explanation: North Dakota limits annual premium taxes for captives to $75,000, encouraging businesses to domicile their captives in the state by capping tax liabilities. Why the other options are incorrect. Option A, this amount is below the actual cap. Options C and D, these amounts exceed the cap. Question 20. Which type of captive is best suited for multiple businesses within the same industry in North Dakota? A. Single parent captive. B. Group captive. C. Risk retention garage. D. Association captive. Correct answer: D. Association captive. Explanation: an association captive is owned by members of a specific trade, industry, or professional association. It provides a cost-effective way to pool risks and manage insurance collectively. Why the other options are incorrect. Option A, single-parent captives are owned by one entity. Option B, group captives may include unrelated entities. Option C, RGS are subject to different federal regulations. Question 21. What is a key characteristic of a risk retention garage compared to other captive structures in North Dakota? A. RGS can write any type of insurance, including life and health. B. RGS must be licensed in every state where they operate. C. RGS are only allowed to provide liability insurance to their members. D. RGS are exempt from federal insurance regulations. Answer: C. RGS are only allowed to provide liability insurance to their members. Explanation: risk retention groups are specifically designed to provide liability insurance to their members and are regulated under the Federal Liability Risk Retention Act. Why the other options are incorrect. Option A, RGS cannot write life or health insurance. Option B, RGS need to register but not be licensed in every state. Option D, RGS comply with federal and state regulations. Question 22. Which entity in North Dakota oversees the regulation of captive insurance companies? A. Federal Insurance Office, FEO. B. North Dakota Department of Commerce. C. North Dakota Insurance Department. D. North Dakota Financial Institutions Bureau. Answer: C. North Dakota Insurance Department. Explanation: the North Dakota Insurance Department oversees the licensing, regulation, and financial health of captive insurance companies in the state. Why the other options are incorrect. Option A, the FIO does not regulate captives. Option B and D, these agencies do not handle insurance regulation. Question 23. What is one advantage of domesticating a captive insurance company to North Dakota? A. Immediate exemption from all taxes. B. Simplified regulatory reporting requirements. C. Access to North Dakota's favorable premium tax cap. D. Freedom to insure risks without a feasibility study. Answer: C. Access to North Dakota's favorable premium tax cap. Explanation: redomesticating a captive to North Dakota allows companies to benefit from the state's competitive tax environment, including a capped premium tax rate. While the other options are incorrect. Option A, Tax exemptions are not guaranteed. Option B. Reporting requirements remain consistent with state law. Option D. A feasibility study may still be required. Question 24. What type of captive would be most appropriate for a global corporation with diverse risks that wishes to insure its subsidiaries in North Dakota? A. Protected cell captive. B. Group captive. C. Pure captive. D. Association captive. Answer: C. Pure captive. Explanation: a pure captive, single-parent captive is owned by one parent company and insures only the risks of that company and its subsidiaries, while the other options are incorrect. Option A. Protected cell captives are used to segregate risks for multiple participants. Option B. Group captives are owned by unrelated entities. Option D. Association captives are for members of a trade or professional group. Question 25. What financial document is most critical when applying for a captive insurance license in North Dakota? A. Statement of good standing from the Secretary of State. B. Pro forma financial statements demonstrating solvency. C. Federal tax filings for the past 3 years. D. A notarized letter of intent. Answer: B. Pro forma financial statements demonstrating solvency. Explanation: pro forma financial statements are essential for demonstrating that the captive can meet its financial obligations and maintain solvency, while the other options are incorrect. Option A. A statement of good standing may be required but is not the most critical. Option C. Tax filings are not a primary requirement for licensing. Option D. A letter of intent is part of the application but less critical than financial proof. Question 26. What is a common requirement for the board of directors of a captive insurance company in North Dakota? A. All directors must reside in North Dakota. B. The board must include at least one independent director. C. Directors must have prior experience in captive insurance. D. The board must meet monthly with the North Dakota Insurance Department. Answer: B. The board must include at least one independent director. Explanation: North Dakota requires at least one independent director on the board to ensure oversight and independence in decision-making, while the other options are incorrect. Option A. Residency requirements vary, but not all directors must reside in the state. Option C. Prior experience is not mandatory. Option D. Board meetings with regulators are not monthly. Question 27. What role does reinsurance play in a captive's risk management strategy? A. It eliminates the need for risk pooling within the captive. B. It transfers a portion of the captive's risk to another insurer. C. It increases the captive's taxable income. D. It is used exclusively for catastrophic risks. Answer: B. It transfers a portion of the captive's risk to another insurer. Explanation: Reinsurance allows a captive to mitigate large or unpredictable losses by transferring some of its risk to a reinsurer, while the other options are incorrect. Option A. Reinsurance complements risk pooling but does not eliminate it. Option C. Reinsurance does not directly affect taxable income. Option D. Reinsurance is not limited to catastrophic risks. Question 28. Which of the following is a benefit of forming a captive in North Dakota for insuring employee benefits? A. Automatic RISA approval for all benefits programs. B. Ability to align risk financing with specific organizational goals. C. Elimination of federal reporting requirements for employee benefits. D. Guaranteed low premiums for all benefit plans. Answer: B. Ability to align risk financing with specific organizational goals. Explanation: Captives provide flexibility to design insurance programs that align with a company's risk management and financial objectives, including employee benefits, while the other options are incorrect. Option A. RISA approval is not automatic. Option C. Federal reporting is still required. Option D. Premiums are not guaranteed to be lower. Question 29. Which of the following would disqualify a captive from maintaining its license in North Dakota? A. Failure to maintain sufficient reserves to cover liabilities. B. Operating in another state without registering. C. Delayed submission of annual premium reports. D. Use of a third-party administrator for claims. Answer A. Failure to maintain sufficient reserves to cover liabilities. Explanation: Captives must maintain adequate reserves to ensure they can meet their financial obligations. If failure to do so is a serious regulatory breach, while the other options are incorrect. Option B. Operating in another state requires registration but does not automatically disqualify the captive. Option C. Late submissions may result in penalties, but not immediate disqualification. Option D. Third-party administrators are commonly used and do not disqualify a captive. Question 30. What is a primary reason North Dakota allows the formation of protected cell captives? A. To encourage tax avoidance strategies. B. To provide cost-efficient options for businesses with varied risks. C. To bypass federal regulatory requirements. D. To limit the number of licensed captive insurers. Answer: B. To provide cost-efficient options for businesses with varied risks. Explanation: protected cell captives enable businesses to segregate risks within individual cells, making it a cost-effective solution for managing diverse risks without forming separate captives, while the other options are incorrect. Option A: tax avoidance is not a primary goal. Option C: federal requirements still apply. Option D: the intention is not to limit the number of captives.